Hey guys, welcome back to Father and Son Investing. It may actually be more appropriate to welcome me back to Father and Son Investing. I know I've made very few videos since about midsummer last year, and there's reasons for that I'll explain at the end of this video. I don't want to bore you with that up front. Let's go ahead and jump back in by starting with the traditional Treasury Bills monthly update, and then following that I'll do another video today on the Treasury bonds and notes update. So let's get started with Treasury bills. We will do this today by first looking at what the market for Treasury bills looks like at the current moment. And then we'll compare that to some savings rates and some money market rates. Then we'll go ahead and look at what the outlook looks like for Treasury bills, we'll say in the next 6 months to 1 year. So looking at the 1 month Treasury bill, we can see what this has been doing for the past year. Boy, look back here how it was, almost 5.4%. Those were the good old days if you're a Treasury bill buyer. Now you're getting roughly about 4.3%. 4.296% is what the current market is showing. That is a far cry from back here again at the almost 4% there, 5.4%. What happened? Well, of course, in September, the Fed started lowering their federal funds rate, and the Treasury bill rate is going to be closely tied to the federal funds rate. Currently, the Fed funds rate is 4.25% to 4.5%, and that happened back in December at the last Fed meeting. Now, if you're buying Treasury bills, you're probably doing that just to manage your cash. Treasury bills generally aren't going to be a long-term savings option because, again, they only last for a maximum of 1 year. So we're going to compare what some cash rates might be to the Treasury bills to try to decide which Treasury bill we might be interested in, or at least which one I'm interested in. So I've just pulled up the bankrate.com website to give us an idea of what current high-yield savings account rates look like. I have Marcus, which is currently at 3.9%, so that's less than what a Treasury bill would offer me. And if we scroll through here, we'll see that as we go down, some of these rates go up significantly. For instance, at Citibank, 4.35%. Of course, you have to have a minimum of $5,000 to get that one. But there are other ones here where Texas Capital, 4.5% with no minimum balance. So eyeballing these, you may be wondering whether it's worth it to do a high-yield savings account versus a Treasury bill. In my mind, it's not worth it to me to be jumping around from bank to bank trying to find the highest rate that I can because these rates are constantly changing. So in my mind, for my long-term savings account, I'm just going to be sticking with Marcus at 3.9%. All right, let's just compare that now to some money market rates because, of course, those are going to compete with our interest in Treasury bills and high-yield savings account. So again, I've just pulled up Bankrate here as a potential example. These rates are actually, as of the end of December, these rates realize can change from day to day and month to month. But let's just get an idea of what this is looking like. This shows VMFXX, which is Vanguard's Federal Money Market Fund, at 4.39%. I actually saw that the latest rate is 4.27%. So you can get an idea of how these can change periodically. And again, if we're looking here, Schwab, 4.3%, JP Morgan, 4.24%, and so on. So we see that some of these are a little bit better than the high-yield savings account, particularly my high-yield savings account at Marcus, and some of these are not quite as good as those high-yield savings accounts. Now I happen to have an investment account at Vanguard, and so my settlement account is one of these money market funds, and it is earning more currently than what my Marcus high-yield savings account is earning. Now, if you're thinking about buying a Treasury bill, you need to know what the interest rate outlook might look like, so that you can choose an appropriate Treasury bill for you in terms of its maturity date. What you see before you here is called the Summary of Economic Projections. This came from the Fed meeting December 18, 2024, and it gives us an idea of what the Fed members are projecting in terms of economic conditions in the near and near midterm future. I have scrolled down to what the participants in the Fed meeting are anticipating, what they think personally. Each one of these dots represents an individual, what each of these individuals think the Fed funds rate will be at in the future. So if we look at each of these individual dots, we'll see there's one person who is expecting that interest rates will remain the same in that 4.25 to 4.5 range. The bulk of the members are seeing it here in this 4 to 3.75% range, with a few outliers going down as low as the 3.25 to 3%. And then if we look out into 2026, you get an idea of what the members are thinking. Again, the trend as they see it is that interest rates will be going down, but we'll notice that it's not going down by that much. These graphs here are another way of looking at these projections, and what you see here is in the blue is the December projections, and in the blue dashes are what they were back in September. You'll notice that there has been a shift towards the right, or towards higher interest rates, between that September meeting and the December meeting, meaning that they're not going to be cutting rates as fast as they thought they would in September. We're going to take a look at two other methods to try to help us get an idea of what the short-term Treasury bill yields might look like based upon what the Fed's interest rate might be. So this is from the CME Watch tool. You can get this here at cmagroup.com. And if we take a look at the 29 January 2025 prediction, they're saying 97.3% that the Fed will not be lowering rates during this meeting. And if we take a peek out to March, we'll see that still 68% is what they're predicting, that the Fed will hold the rate that it currently is at. In fact, it takes us a while to get out to where even 50-50 chances here that the rate would dip below 4%. You can see here going out into June, still 75% chance that the rate will either be the same or only down by 25 basis points. And if we look even out to the end of the year, adding these up, it's still almost 50-50 that the rates won't go lower than that 4 to 4.25%. So what does that tell us? It tells us that the market is predicting that the Fed might have 1, maybe 2 rate cuts for this year. Lastly, as our third way of kind of getting an outlook for what Treasury bill rates might look like in the near future, I like to look at what the Fed officials have been saying. So this one is from Bowman, who's one of the governors, Michelle Bowman. The headline says, "Rate cuts on pause until inflation declines again." This one is kind of a summary of what happened with the minutes when they were released from that Fed meeting back in December. Fed isn't certain where interest rates will head. Minutes show inflation and Trump are concerns. This one is a summary of what both Adriana Kugler and Mary Daly had to say at a recent event, and the headline here says, "Inflation fight isn't over. Fed officials say what they're watching now," implying that if inflation isn't done, then their rate cuts may not be coming as quickly or as soon as previously anticipated. And lastly, as one more Fed official, at least on the camp of not cutting too much, Kansas City's Fed Jeffrey Schmid sees no rush for more cuts. Now, there is a semi-contrary view here, and that is Christopher Waller, one of the Fed governors, and the headlines regarding him are still saying rate cuts possible in the first half. He's not saying they're going to happen, but he's not leaning quite as much towards them not happening as some of the other Fed officials are. Moving over to the Wall Street Journal, Fed official says further rate cuts can wait. This is the St. Louis Fed's bank president. So there's another one in the not cutting too fast and too much camp. Interestingly, in Barron's recently on January 10, at least someone at Bank of America thinks that rate hikes are potentially back on the table and rate cuts are over, according to one Bank of America official. And an interesting article in the Wall Street Journal on January 14th of this year, "What if Fed U-turns and raises rates this year?" So we see a lot of folks who are saying rate cuts on pause or not as many rate cuts this year, and at least 2 financial publications implying that potentially raising rates is back on the table. Lastly, the wild card in all of this, of course, is a new president coming in on Monday, January 20th. The headline here in the Wall Street Journal, "Trump versus the budget hawks, how the GOP spending fight could spread to Wall Street." So this one to me is a big unknown. There's a lot of predictions about what would happen with some of the policies that President Trump has stated he would like to implement. However, how quickly and how much of some of these policies that he stated will be watered down or pulled back is an unknown, and therefore where short-term Treasury bill rates may go potentially is an unknown as well. So what do I like when it comes to Treasury bills right now? Well, for me, I'm going to be going with the 1-month Treasury bill. Why is that? Because I'm going to be using the cash in my high yield savings account, currently getting 3.9%, to squeeze a little bit more out of there, get that up in the 4.3% range. That's what I'm going to be doing with my cash. What's in my money market account at Vanguard is just going to be staying at that 4.27%. I am comfortable with that. Now, I can't fault anyone for choosing a 6-month Treasury bill. Of course, you can lock in that almost same rate as the 1-month bill for 6 months. I, however, want to keep my cash a little bit more liquid, so I'm just going to stick with the 1-month bill, and I'll take a wait and see approach on that March meeting, thinking that if I really wanted to lock in a 6-month bill, I still have time to do that. So that's it for my summary when it comes to Treasury bills. Now I'll talk about where I've been for the last 6 months or so. Some of you may recall that I had mentioned previously that I had a positive tuberculosis test. And that was what we call latent TB. It wasn't active TB. I wasn't coughing where I would be infectious to other people. But man, I felt just so lousy, and I really wasn't sure it was the TB that was doing it, that I didn't want to start adding another treatment to what I already take medicine for. So in November, though, I finally was so tired of feeling so bad, having chills and fever and muscle aches and whatnot, that I went ahead and started some TB treatment. Well, 2 months later, I'm feeling significantly better, and maybe that latent TB wasn't so latent after all. So one of the interesting things when I started taking that TB medicine, though, is that my atrial fibrillation, which I have intermittently, kind of went crazy. So much so that I was having it every day, which really makes me feel lousy when I'm in atrial fibrillation. One more reason why I don't want to do videos when I feel that bad. If I'm honest, though, there was also one more factor of why I hadn't done many videos, and that was because a prediction I made back in September in regard to TLT and a chance to make some money on that was a total bomb. Well, it was about a half a bomb, because I had thought that long-term yields would go down before they went back up, and they really didn't go down any lower. If you watch that video, you'll see that I thought that because of the government debt that eventually long-term yields would be rising, but I did not anticipate at all that that would be happening so soon. So I really bombed that one, and a lot of the negative comments really kind of sent me for a tailspin when it came to financial videos. So there you have it. That's why I haven't been around for several months. Hopefully with this TB treatment, I'm feeling much better, and I'll start making more videos. If you have any comments, feel free to leave those. Otherwise, until next time, enjoy your investing.